Greetings from Finstudyclub. My name is Ankur Kulshrestha, welcoming all viewers to the video series on 10 very important questions for financial reporting and analysis, wherein we will be talking about some of the very critical concepts for FRA, which is 20%, the most and the most weighted topic of your level 1. The idea to create a video series like that is to share the experience that we've had after teaching 7 years, 70 batches for level 1, and bringing forth some of the very critical concepts which are very fundamental and important for your success in level 1 exams. So the way we have been doing is, for other modules, I think that's the best way to go about for FRA as well. That is, you pause the screen for every question. This deck has got 10 questions, very selected questions. So you pause your screen. So you pause the screen and do the question yourself. And after that, try and match it up with my answers. This way, you will exactly know where or at how many places are you getting your fundamentals wrong. So that's the most effective and objective way of looking at each question here. So this video should cover roughly about 30 minutes, and this should be a good return on time investments that you are expected to make out of this. So I'm starting with my first question. You should pause the screen and try and take an attempt yourself. Here is the data for a furniture company for the year 2015 and 2016. There are particulars for Chair 1, the first product, and Chair 2, the second product. There are, raw material cost, 500, 100, 600, and 150 is the labor cost also included. And then the year of production, both of the chairs got produced in 2015. The year of sale is different. So one is being sold in 2015, while the other is being sold in the next year. The selling price, of course, is different according to the specifications of each chair. The question is, there was showroom rent in both the years to be equal to $200. How much is the profit that should be booked in 2015 and 2016? Now you would recall that in revenue recognition, in your readings of income statement, you were told to learn the revenue minus cost is equal to profit. So there were rules for revenue recognition and there were rules for cost recognition as well. So I'm talking about 2015. Only chair 1 has been sold, so the revenue equal to 800 will come into picture. And as far as the cost is concerned, all the direct expenses relating to chair 1, which is 5 plus 1, is 600, should be taken to P&L, and all the indirect expenses belonging to that time period should go to. So the rules of expense recognition was that the direct expense should always be matched. There was a principle of matching to be followed with the corresponding output, and indirect expense of that particular year. So the showroom rent for 2015 is going to go to the P&L of 2015. So keeping that in mind, I get a value of nil in 2015. So the profit to be booked in 2015 is equal to 0. Let's talk about 2016. Now again, the same fundamentals. In 2016, the second chair has been sold for 1200. Let's talk about the cost. As far as the direct expenses are concerned, 750 will form part of the second year, and the showroom rent of 200, which is anyways an indirect cost, which is anyways a period cost, should go to the second year's income statement. So overall, the profit that is being made is 0 and 250. Now there is a very interesting way to ensure that the accounting that we are doing is correct, and that way is called as looking at every transaction from the point of view of A is equal to L plus C. So what I'm going to do is, from an expense standpoint, I'm going to ensure that I measure all the changes in me in 2015 and see whether this equation tallies or not. This is like the basic accounting equation, the balance sheet equation. So here I am. So if I ask you what is the total cost that you have paid, what is the cash amount that has been paid. So let me write cash here. Cash will go down. Now I want you to tell me the amount by which it will go down. Well, the answer is 600 plus 750, which is 1350, and this 200. So your cash goes down by 1550. You got to bear in mind that the Tier 2 has also been produced in second year itself, and I'm assuming that none of these expenses accrued. I mean, everything has been paid for, so there is a total expense paid for 1550, out of which an expense of 800 has been taken down to P&L. So ceteris paribus, greater the expense, lower the profit, and profit belongs to the capital provider. So my 850 goes out of my capital. The part is, the equation doesn't tally. There is still 750. So there is still a gap of, this is 800. So there is still a gap of 750 which is pending. So that 750 is nothing but the value of the finished goods, which is part of your inventory, and it is your asset. So the assets go down in form of cash by 1550, finished goods go up by 750, and therefore net change in the assets is 800 down, and net change in the liability is 0. Net change in the capital also is 800 down. So overall, if you look at it, your equation is getting tallied. So that's how you got to understand that the dealing that you've done, the calculation you've done, is correct. Let's talk about this equation in 2016. For the expense part, your cash goes down only to the extent of 200, because now only the rent will have to be paid. Your finished goods as an inventory will again go down by 750, because this was produced last year but sold this year. So this is what is 750, and your net P&L goes down by 950. So that said, my accounting becomes complete, and hence my answer 0 and 250 appears to be the correct ones. Okay, let's talk about the second question here. My second question is on the Soft Corporation, which gives chemical worth rupees 50,000 to the West Side Rivers in exchange of her services. Now what is happening is, Company A is giving to Company B some services and taking some goods in favor. So this is a classic case of a barter transaction. The question is, how is revenue recognized in this case under IASB, which is my IFRS, and FASB, which is my US GAAP? Well, this is like a conceptual question, not a numerical question. In case of US GAAP, I can book this at fair value only when there is some historical experience of a non-barter transaction. That means a cash transaction. So under US GAAP, X and so the Soft Corp and West Side Rivers, both these companies will be allowed to book revenue at fair value only when there is a historical experience on a non-barter, which means on a cash basis. However, in case of IFRS, not only that is important, there is one more condition, that this has to be with a non-related party. This is something very, very critical. So that said, my IASB is more strict. It has all the rules of FASB, and one more rule, that the same non-barter experience has to be with a non-related party. The objective of that is that a non-related party always gives you an objective assessment of the price. The related party is always a biased price. So that was my second question. Moving on to a third and a very important question I have for you is on the earning per share. A company has 100,000 outstanding shares at the beginning of the year. Okay, on 1st April, a bonus of 2:5 is issued. On 1st July, stock was split into 2-for-1. And on 1st November, 40% of the shares were repurchased. So if I have to plot that on a number line, there are 4, or should I say 3 events which are happening. So on April, on July 1st, and on November. Okay, so I have outstanding shares, then there was bonus, then there was split, and then there was repurchase, and then this is obviously the closing value. Now you would recall that for calculation of earning per share, what you need is the total earning divided by the weighted average number of shares. And while calculating the weighted average, bonus and split does not have any relevance with regard to the date. The shares will be deemed to be outstanding from the date of base shares. What I mean by that is, in effect, if the bonus of 2:5, which means 40%, which means 40,000 new shares on 1 lakh. So these 40,000 shares came into existence from 1st April legally, but they will be deemed to be outstanding from the date of base shares, which is like 100,000 have been outstanding from 1st Jan. So we'll assume that since beginning they were 140. Similarly, the split 2 into 1, so 140 shares, because now you have 140 shares legally, have got one more share for each one. So in effect, now you have total 2,80,000 shares with you. But these 140 additional shares that have come into existence would also be deemed to be outstanding from the date of their base shares. You will have to recall that it is in 3 cases: split, consolidation, and bonus, that the date of announcement is not relevant for the calculation of weighted average. So I have, in place of 1 lakh, I have now 280,000 shares being outstanding from 1st of Jan. And now the third event which happened is the repurchase of 40%. So 40% of shares which were existing, so 28 into 4, 112,000. These were the shares which have been outstanding, been the bought back, or the treasury stock, as the case may be, from 1st of November. The question is, would you again consider them from the date of base shares? Answer is no. So they will be outstanding for 2 months, and they will be outstanding for 12 months. So 280 plus into 12 by 12 and 112 negative into 2 by 12 gives me an answer 261,333. So this becomes the weighted average number of shares that I'm going to take in your denominator. Okay, so that's like an important question from point of view of the earning per share. Let's talk about another question from earning per share, and this time from the diluted earning per share. This question is on the partly paid up options, wherein assume that the exercise price of an option is 11 rupees and the average market price of the stock is 16. Now I hope that you guys are practicing in the way it should be. Before every question you got to pause this question, attempt it yourself, and then look at the answer. Please don't just look at this video. It will be better if you are hands-on on this particular aspect. So what we are saying is that the average market price of the stock is 16 and there are total 1039 options outstanding for the entire year. What is the number of shares to be added? Important exam point, I'll come to that, to the denominator of diluted EPS. The second question is, what is the denominator itself? Now there are 2 questions that are being asked. What is the number of shares to be added, which means only the delta? And the second is, how much is the total denominator for diluted EPS? The objective of giving you both the questions is you have to be absolutely clear in the exam as to which is being asked, and because the number are very, very different. One is the delta, the other one is the total. So this concept relates back to the concept of potential security, where the security is not in form of equity in the current year but can become equity tomorrow without paying any consideration. So potential security could be dilutive or it could be anti-dilutive. For the purpose of calculation of diluted EPS, I am considered with the dilutive potential security. What we also know that options are always dilutive if their exercise price is less than the average market price per share. But the challenge that comes up here is that out of 16, you are not giving them this option fully free. You are charging them something. So the dilution is only to the extent of $5 of discount or 5 rupee of discount that you are giving him, the employee as a gift. So in case of partly paid up option, you would recall that we used to divide it into fully paid up and fully free. It's like saying if I have done 40% of my course, there are two ways of looking at it. All the books have been done 40%, then also my course completion is going to be 40%. Or we can also say that 2 books have been done incomplete and 3 books haven't been touched. So in this case also 2 out of 5, your course completion will become equal to 40. So I am interested to convert this gray matter, which is a partly paid up issue, into absolutely white and absolutely black. Always recall that the dilutive securities are one which will have the impact of reducing the EPS, and therefore I am interested in looking at the fully free portion. I am not interested in looking at the fully paid up portion as such. So the way to calculate was, there were 2 ways to look at it. One was the treasury stock method, wherein we used to calculate the fully paid up shares, saying that assuming that all the option holders exercise this option, so I'm going to get this much money from them, and using this much money, if I start buying my own shares, I'm going to get a number equal to 714. Okay, but legally I have issued them 1039. That means I have issued 325 shares fully free. So here I am being able to divide. So 1039 options have been partly paid up. Out of that, the fully paid up number that I got was 714, because the money that I have got on 1039 options was equal to only 714 shares if fully paid up, and the fully free portion is like the remainder of the 2. Okay, the other way to look at this is 1039, out of that, how much is the discount which is being offered? Discount of 5 over a number of 16. So this is like a discount percentage that I am getting on this total number, which will directly give me the fully free value of 325. So the number of shares to be added is 325, the fully free portion. It is not fully paid up. This is an exam question, and again a query, an error that is expected to happen from most of you. The next question here is, what is the total denominator of diluted EPS? Now for that, you should recall the formula that diluted EPS was equal to numerator for basic EPS plus various deltas and denominator for basic EPS plus potential securities. Now in this question, if you read it again, the basic EPS is not available, nor is the denominator of the basic EPS available. Therefore, we are not in the position to answer the second part here because of the lack of the data. But in a particular question, let's say in the exam, you might be given the basic EPS, let us say, is $5. And how do you get to $5? Let's say 20,000 divided by 2,000. That means 2,000 becomes my denominator for basic, in which case my answer here in the second part, the total denominator will become equal to 2325. Okay, so that was my fourth question for you. Very, very important concept, from the exam standpoint. So let's come to question number 5, which is from long-lived assets. And actually it's a combination of long-lived asset and cash flows. So the question says, an asset whose net book value is $40,000 was sold for $48,000. The tax rate applicable on capital gains is 20%. Report different cash flows as per the US Gaap and Ifrs. Now you would recall that there were 3 categories of cash flows that you have: CFO, CFI and CFF. What the question asks us is, as per the transaction that is being given, how are different cash flows to be classified here? The easiest part is to catch the cash, and this is exactly where most people will commit a mistake. 90% of the student will write 8,000 as the amount of cash, whereas the cash inflow is 48,000, which is part of investing activity. Obviously it's a long-term asset, so it is part of investing activity. The out of 90, so 90 people would have committed this mistake. Out of the balance 10, about 8 students would just stop the answer here and write 48 as one of the options, whereas it's only the balance 2% which you are going to talk about, that there is a gain of 48 minus 40 equal to 8,000 multiplied by the tax rate. So you got to pay this much tax also. There is something called as tax flow. So tax flow, $1,600, needs to be paid to the government because you have had this gain. And that's where the US GAAP and IFRS differ. My IFRS says that whenever you can decide and make a connect of a particular tax amount with the income, you should classify it accordingly, respectively, with that income itself. Whereas my US GAAP says taxes on any kind of an income needs to be shown under CFO itself. So in a way, the basic transaction 48 and 48 remain same, but the tax treatment remains different. Obviously nothing comes under financing. So the final question might ask you any amount. It might ask you about CFO, it might ask you about CFF, it might ask you about the net cash flow overall. So in both the cases, net cash flow remains to be equal to 46,400 in both the cases. Only the classification difference is there. Okay, with that I am at a very interesting question, question number 6, which is part of inventory, wherein I am basically talking about the balance sheet valuation of the inventory. So you got to pause the question here, try and make an attempt yourself, and then maybe look at how are you faring with the with my answer. So it says that ANC Limited sells specialized shoes. At the year end, due to sudden increase in manufacturing cost, the replacement cost is 55. The historical cost, maybe because of LIFO, FIFO or weighted average, is 43. And the current selling price, which is the realization value, is 50. The normal profit margin is 10% of the selling price, which means $5, and the selling cost is $3 per pair. $3, 3 rupees. Now, according to US GAAP or IFRS, which of the following amounts should each pair of shoes be recorded on the year-end balance sheet? So ultimately, it's a balance sheet valuation question which has a rule: cost or market value, whichever is lower. So let's talk about the US GAAP first. As per the US GAAP, the rules are cost or replacement, whichever is lower. And second step, if replacement is lower than the cost, then the balance sheet value has to be between a band, and that band is NRV on one upside and NRV minus profit margin on the other side. So I'm going to put in some values here. My cost is 43, replacement is 55. Which of the two is lower? 43 is lower, therefore cost is lower. The entire gamut of the entire trap in this question is the second question under US GAAP comes up only when the replacement is lower than the cost, which is not going to be applicable in this case, and hence 43 becomes my answer. Whereas a lot of students here will still try and make things here, write something here, and then maybe give an answer. So let's just see what is a common mistake that you would do. So your net realization value is going to be 47 and NRV minus profit is going to be 42. So what you will think is 55, replacement is 55, this value is going above this 47, and therefore you will write 47 as the main answer. But the entire gamut, the entire trap is that the question gets solved only at step 1, cost or replacement, whichever is lower. There is no need to go to the step 2 itself. Okay, so as per US GAAP, my answer is 43. Let's talk about the answer as per IFRS. IFRS is pretty straightforward and simple in that sense. It says cost or NRV, whichever is lower. The cost is, now putting in the values, cost is your 43 and NRV is 47. Whichever is lower, again answer comes out to be the same as per IFRS as well. Okay, so that's pretty interesting a question. The question will have traps for you like that. Let's talk about another question here. Question number 7, which is on a very important aspect of impairment loss. Again, a very important question from an exam standpoint. It says, consider the following situation for equipment owned by a company. The original cost is 200,000. Accumulated depreciation so far is 50,000. That means the net book value is 150. Undiscounted expected future cash flows is 160. The fair value is 170. The value in use is 140,000 and the selling cost is 35. So my NRV, if I sell the asset, becomes equal to 135, which is 170 minus the selling cost. I need to calculate the impairment loss as per US Gaap and IFRS. Now, as per US Gaap, there are two steps of impairment loss. First is just the recoverability test, in which I need to compare the undiscounted cash flows with the net book value. If net book value is less than the undiscounted cash flows, then obviously the recoverability test has been a negative. Therefore, there is no need to go to the second step, and therefore you will have to avoid calculating the impairment loss. There is no need to calculate any impairment loss as such. Okay. As per IFRS, on the other hand, IFRS, you have the net book value being compared with the recoverable amount, which is higher of the two, the fair market value or the discounted cash flows. Now, fair market value is 1,35,000, the value that you're going to get if you sell the asset right now. The value in use, the discounted cash flow, is 140. Therefore, greater of the two, obviously as a businessman, I'm going to do what benefits me. 1,40,000 is what I will be able to recover from the asset, and the net book value is coming out to be 150. Therefore, as per IFRS, impairment loss is equal to 10,000. So both the standards give you a different answer for US Gaap as far as the IFRS is concerned. Let's talk about another very important aspect on leases. Now, you would see that so far we have covered balance sheet, income statement, cash flows, a little bit of inventory, long-lived assets. So it's pretty much comprehensive coverage of the entire curriculum. And the questions that are being chosen here are the ones who will expose you to certain weaknesses. Now, obviously, like that short of video can't be an all-comprehensive video, so please don't consider them itself to be the final revision source. But yeah, these 10 questions are like the bare minimum that every candidate should definitely know before landing into the exam. So here I am with question number 8. It says, assume the following capital lease. Now, A, it's a capital lease. So there are two types of lease operating in capital. So this one is clearly mentioned to be a capital lease. The present value of the lease payment at 10%. So this becomes the IRR of the lease, the rate at which the lease payments etc. has been calculated. So the PV is 25,000. The leased asset is depreciated straight line over 5 years. So okay, so whatever is the value of the asset, I will depreciate that by 5 years. The lease payment is rupees 6,000 every year. The first payment of 6,000 is to be paid at the end of the year. That means it's a regular annuity. Calculate the impact on income statement of the lessee and lessor for first 2 years. So what we have to find out is income statement of lessee and lessor for year 1 and year 2. Now these questions are very easily done if you know the fundamentals and the formulas behind it. So you would recall that in case of the lessor, in case of a capital lease, it's only the interest income that comes up. So for that I will have to make a quick table, and to calculate the interest part, that will have to be borne by the lessor here. So in the first year itself, I can tell you the lessor will experience an interest income. So the present value of the lease receivable is 25,000, on which a 10%, 2,500 is going to be the income that she will get. Now in the second year, if you will make the quick calculation, out of the total principal of 25 plus an interest, the total lease recoverable is 27,500. During the year he recovered 6,000, therefore the closing lease receivable is 21,500, on which again in the second year he is going to earn 10%, so his income is going to be 2,150. There is like a detailed video on finstudyclub.com to explain the lessee and lessor under different situations in a very precise, concise and the effective manner. So I would expect all the viewers who are facing any problem just to go on to the YouTube channel of FinStudyClub and benefit from looking at that video. Now as far as the lessee is concerned, now the lessee has got a loan and an asset on its books. So as far as the loan is concerned, the interest that is the income for the lessor is an expense for the lessee. So I don't have to calculate this particular aspect again, and I can quickly, the interest income for the lessor has to be equal to the interest expense for the lessee. So in that case, my interest is sorted out. What remains is as to the depreciation of it. So there is no present value, the value of the asset being given. So I'm going to assume it to be equal to the present value of the lease, which is equal to 25,000, and the asset being depreciated over 5 years. So the depreciation of 5,000 is going to be charged. Okay, so that's how is your impact on the income statement of the lessee and the lessor if it was a finance lease. What you have to appreciate the fact is that out of 6,000, 2,500 is the interest and 3,500 is the principal repayment. Now principal repayment is something which will not come in your income statement. That is something that will get deducted from the loan liability, like the case here. So if I have to just quickly do A is equal to L plus C for the first year at least, then your cash for the lessee will go down by 6,000, out of which the P&L goes down by 2,500 as the interest portion, and the balance is the reduction in the loan liability. The P&L gets impacted only by the interest portion, so please don't reduce that by entire 6,000. Okay, so that was like an important aspect here. The second part of the question is, what would be the change if the lease was an operational lease? Now in case of an operational lease, accounting is very simple. I'm using a black pen here. So in case of my first year, the lessee is going to record an expense of 6,000 in each of the year equal to the lease payment. He doesn't own the asset now. Asset is being owned by the lessor. Now lessor will have an income of 6,000, like an operational income, regular income, and in addition to that he is going to charge the depreciation. So overall, if you look at it, the lessor is making 1,000 per year and lessee is making a payment or bearing an expense of 6,000. Okay, so operational lease accounting is fairly simple compared to the financing lease. So if my question was operating lease, my answer would be, for lessor it is 1,000 per annum each year, a net income, plus 6 minus 5, and for lessee it is going to be minus 6 each year. Okay, so here I am at my 9th question, and in that we are going to test the concepts of the financial liabilities, and in that we are referring it to the bonds. Now this is like a pretty much like a case study sort of, because I mean the exam question would not be what to say, I mean they will not have so many parts to it, but just for the sake of clarity and holistic learning, out of this particular concept, I have added a lot of points, small points, so that you can get a 360-degree overview of the entire stuff. So my question starts by saying that a firm issues a 10 million bond, which is like the face value. This is not the fair value, but the face value, the 6% coupon rate, a 4-year maturity, and an annual interest payment. In the exam, watch out if it's a semi-annual, because if in that case your coupon will become half, and your whatever is your YTM, you got to then multiply by 2 to give me the bond equivalent yield. So like these are some of the concepts that you got to be very good and strong at. So now coming back to the question, and the market rate at that point in time was 7%. So answer the following subpart. So here my first part is plot the cash flow on the timeline from borrower's point of view. Now a question like this will never come to you in the exam, but this is like a very good question for understanding standpoint. 4 years, so I've plotted 4 years, and now I will be plotting the payment. So like annual payment, so 10 million into 6%, so the coupon will become 0.6, okay. The final payment will be 10. So all the blue figures are outflow, and the issue price, which is going to be plotted here, will have to be calculated, which is issue price is the market price, which is nothing but the present value on my beta 2 calculator. So I want you to calculate it with me. If the PMT is 0.6, N is equal to 4, future value is equal to 10, and I by Y is equal to 7, compute the present value. Gives me an answer 9.66. So 9.66 becomes the issue price, the value at which the bond will be issued. The second point is it a premium bond? Well, the market rates are more and the coupon is less, therefore it becomes a discount bond. Okay, you can also evaluate this point from the fact that the issue price is lower than the par value, the redemption value, therefore there is a discount which is being offered, hence it becomes a discount bond. Third is, what is the annual coupon? And the annual coupon is 0.6. D. How much are the total cash flows paid to the bondholder? Now, it's like a simple question, but sometimes simplicity has its own complexity in the exam hall, because you sometimes tend to overread the question. It's a very simple question. It says, what is the total cash flow? So 0.6 being paid 4 times along with the principal repayment. So we are not talking about the entire cash flow on the timeline. It is like cash flow paid to the bondholder. So you would have taken something, but that's not to be counted. It's like 0.6 into 4 plus 12 gives me a number of 12.4. Very simple and straightforward. Now these are the questions which are more important from an application and an orientation standpoint, because this will involve knowledge of something called as the amortized cost. Let me just quickly bring this up. Your amortized cost is the present value of future cash flows discounted at original YTM, original. At the same time, your market value is also the present value of future cash flows when the YTM of that particular time zone is itself calculated. So what I mean by that, if I have to calculate the amortized cost at T3, I'm going to still follow the original YTM, which is in this case my 7%. This was the original YTM prevailing at T0. YTM is nothing but the market rate of interest. However, if I were to calculate the market value at the end of the third year, I can't use 7% because it was the rate prevailing 3 years ago. I will have to follow the market rate prevailing at that point in time. So it's the difference between amortized cost and market value exactly is the fact on the difference in the discount rate. Why this is important is because now in part E, you have to calculate the interest expense for year 2, which is equal to the amortized cost at the beginning of the year multiplied by original YTM. So I got to calculate the amortized cost at the beginning of the second year, which is at T1, which is right here. So if I'm standing at T1, how much is my future cash flows? 0.6 is the PMT. So the way I want you to do that is, be with me and let's just quickly get this done. Let me clean the board a bit for you. We are calculating the amortized cost at the end of the first year. Okay, so my PMT becomes equal to 0.6 and now becomes equal to 3. Bear in mind that you now only have 3 years remaining. Your I by Y remains at 7% original YTM and your future value becomes equal to 10. Therefore, your amortized cost is the present value here, which is coming out to be giving me an answer of 9.74. So this is the value in my books. This is the amortized cost at T1. This is not the market value. And if that is being multiplied by 7%, is going to give me the interest expense equal to 0.6816. That's your answer for part E here. Okay, pretty simple and straightforward as such. My next question is on the amortized value at the end of year 3 and year 4. Now here, if you look at it, just again clean the board a bit for you. What you have to find out is the amortized cost at the end of year 3 and year 4. What you have to very carefully notice, if I'm standing here, then n will become equal to 1. So all the figures that are already fed into your system, PMT is 0.6, I by Y is 7, future value 10, you just have to press 1 is equal to n and compute present value. So the value that you're going to get here is 9.9. So the answer for the opening amortized value for year 3, I didn't read that word opening. So in that case, opening for year 3 is going to be a value here. So therefore n should have been equal to 2. And to compute PV is 9.82. So the answers here is, and this will become the opening value for the fourth year. So the answers here are, for opening value for year 3 is 9.82 and from here is 9.9. Again I'm saying if I'm standing on this timeline, my n becomes equal to 2. If I'm standing on this time zone, my n becomes equal to 1, and that's how you're going to calculate the amortized cost, present value of future cash flows at original I by Y. Point number G is more to do with IFRS, wherein there is an issuance cost of $50,000 and that needs to be, as per IFRS, deducted from the present value itself. So issuance cost will give you the net cash flow at T0. Because of that, you need to calculate a revised I by Y. Obviously, if the present value has gone down a bit by 50,000 in this case, your I by Y will stand to increase little bit. So I am doing this calculation standing at T0. I will get a value of 9.66 from the investor. Out of that, $50,000 have been paid to the underwriter. Therefore, my new present value will become 9.66 minus 0.05 equal to 9.61. So if you have a lower present value, you got to now calculate a revised I by Y. Let's do that. So your PMT becomes equal to, it remains at 0.6 actually, future value remains at 10, your N remains at 4, your PV now becomes 9.61. Please don't forget to write PV in the opposite sign and compute I by Y. You're going to get a value which is a little more than 7, and I'm getting a value of 7.15%. That's where, my effective interest rate under IFRS is going to be calculated. Okay. Now, as for the US GAAP, the issuance cost will not have to be deducted from the initial cash flow itself. On the other hand, it is taken on the asset side of the balance sheet like a prepaid rent. So it's like a 4-year rent of 50,000 being paid in advance. So the question that asks is that what shall be the value of the prepaid issuance cost at the end of the 3rd year? Now, what you have to understand here is that the $50,000 amount is being sort of depreciated or taken to P&L at a constant rate of 12,500 every year. So by the end of the 3rd year, the amount that you have already taken to your P&L is 37,500, which means the remaining prepaid cost in the books is $12,500 only. So this becomes my answer. The unamortized issuance cost is sometimes, as it is called, is 12.5, which is the value which is there pending only for the 4th year P&L. Okay. With that, I am at the last question of this series. Herein we're talking about income taxes, which is sometimes one of the most dreaded concepts from an exam standpoint for a student. However, let's try and do that in the most simplistic manner as far as possible. So here is a data table as per the rules of financial reporting, wherein I've kept the constant sales of $100 and there is a provision of 20 which the accountant believes is going to be a bad debt out of the sale that he has made in year 1. So as per the rules of accrual, you got to match the direct expenses, and that's exactly what accountant has done. Because of that, your profit before tax has gone down to 80. Now obviously the rules of the income tax do not allow the expenses on a provisional basis. If I were to draw, if income tax has to redraw the same income statement, they will give you an expense only to the tune of the amount of bad debt that you will actually experience. So the actual bad debt were 15 in the 1st year. So by the red color, if I am redrawing the income statement of the same company from the income tax standpoint, then I will have the total taxable income to be equal to 85. There are tax rates which are differently given in this question. Now this again an exam point. 99% times in practical cases you're really not sure how much is going to be the tax rate in the future years to come, but sometimes if the question tells you that the tax rates are where, let's not get into an ego issue. So let's just quietly follow that, and what you have to calculate are different figures. So let me just redraw all the years on the basis of the data which is given to me. So there is a timing difference which is coming up in the 1st year, which is reversing itself in the 3rd year. Okay, so let's calculate the following figures for the 1st year. The current tax is the tax as per the rules of the government, and that is 85, the taxable income, multiplied by the tax rate 30%, which is $25.5. So that's my first answer. How much is the current tax? My second answer here is calculate the deferred tax asset or liability for the balance sheet. So let's just first evaluate whether it's going to be an asset or a liability. Well, right now I am asking to pay tax at a lower income, whereas I am being taxed at a higher value. So that means I have to pay more. Whenever you have to pay more, you get into the scenario of a deferred tax asset, which gives you the value to be equal to the timing difference of $5 multiply by the tax rate of the year of reversal. So the reversal is happening at 50%. What you have to be carefully notice, the deferred tax asset is not the rate at which the timing difference originates. It is the rate at which the timing difference reverses, which is 50% in this case. So answer to that is $2.5. There is a question of income tax expense, which is equal to the current tax plus minus the change in deferred tax. So an asset has been created during the year, which is equal to 25 minus 2.5 is equal to 23. Okay, so 23 becomes the answer for my income tax expense. And then the final question of effective tax rate, which is equal to income tax expense divided by the profit before tax, both the figures of financial reporting. You get finally $23, and your own, the accountant's PBT, gives me a value of 28.75%. Okay, so in the exam, like I said at the time of bond itself, that not all the questions that you're going to look at here are going to come up, but any one of them might come up. So that said, all the questions become relatively important. So with that, I am towards the end of my video, and I hope that, like corporate finance and other modules, this too has been very, very useful. And like I mentioned at the beginning, that the endeavor of Finstudyclub and the trainers here is to share the experience that they've got and the questions which they think are most crucial at the last leg of the transaction. So for those who have started their preparation late, just ensure that they do all these concepts very well and do them first, before doing anything else. All those who have completed their preparation, just check these questions as a parameter, and if you're able to get 80% of these right, then assume that you're doing good with your preparation. We'll be very happy to hear from you, or read from you at any of the numbers or the email IDs which are given. So there's like a subject specialization that I and Amit have. So would request you to give us the calls accordingly, should there be any question that you have. So stay tuned and try and ensure that you look at all the videos of all the 10 modules before that. All these videos have been uploaded at the YouTube channel where you are looking at it. So wish you all the very best, and I hope that you score very well in your level 1 exams. So with that, thank you very much. I look forward to speak to you in my other sessions.